Hey, what's up? This is Jerry with Wealth Dynamics. If you know me, please like, share, and subscribe to this video. If you do not know me, I take personal responsibility for that. I apologize. That's totally my fault. We're going to solve that problem right now. Today, I want to talk to you about how to build top 1% kind of wealth with life insurance. Now, before I start on this topic, I do need to disclose here. There's a little tiny sliver of life insurance out of all of the life insurance that exists in the entire universe that works for what I'm about to talk about. Okay? So to clarify, if you know anything about life insurance, term insurance does not do what I'm about to talk about. Don't do it. IUL, Indexed Universal Life, it's a scam. Don't do it. It's not going to do what I'm talking about. Variable universal life insurance does not do what I'm about to talk about. Standard whole life insurance does not do what I'm about to talk about. 99% of the life insurances you guys hear about and know about are indeed a scam, and they will not do any of the things I'm about to share with you. Okay, now that we have that off the table, let's talk. So, first things first, the reason I use life insurance personally is it forces me to save money. I hate 401k plans. You know that already. But the only thing that I can say that's good about the 401k plan, many of us would be broke if it wasn't for having to put money into it. Okay, if we didn't have our boss force us to stick money into Wall Street's van, I'm just going to go ahead and use that reference because that's what's happening, then you would have no money. Period. Okay, so life insurance is like this. You're going to tell the insurance company, I'm going to put $1,000 a month or however much a month into this policy, and you're writing a contract. It's a contractual obligation. You're promising to do that, and every month it's auto-drafting out of your account. You have no choice in the matter. I freaking love that because there's no if, and, maybes, or buts about will you save money. Okay, now here's the deal. There's a couple things that the life insurance is going to do for you. I'm just going to kind of read through some of these things that I came up with, and I want to make sure that I really get these across. Now, first things first, isn't life insurance a scam? Isn't that the question that's going through your head? Didn't Dave Ramsey tell me not to? Let's handle that real quick. Like I said, 99% of it is. This is the 1% you didn't know about. In fact, the one I'm about to tell you about, it's been used by guys like JCPenney. I would love to own JCPenney's. Even though retail is getting hit hard, I would still own that business. It's better than most other businesses we own today, right? Walt Disney, I would love to own Disney. This guy used this strategy. Ray Kroc, McDonald's, who would like to own McDonald's? Ray Kroc used the same strategy, okay? So success leaves clues, so does failure. So when you're getting the, hey, this is a scam advice, look at the result of the person that is telling you that and ask, what clue are they leaving? Success or failure? If it's failure, then the advice is invalid. I want to follow guys like Ray Kroc. I want to follow guys like Walt Disney. Okay, so here we go. We're going to dive into it, and we even got some life insurance people watching. This is going to be great. So basically, the policy that I'm going to tell you about, it is properly structured, high cash value, dividend-paying whole life insurance. Now, it needs to be set up a certain way. Just like anything, if you do this wrong, it will not work. If you do this wrong, an insurance agent is going to make a giant commission at your expense, and you will have nothing. Okay, so it has to be done correctly. I want to stress that. So here's the deal. When you set these up properly, you're basically sticking money into the account. Okay, 30 cents of a dollar, let's say you put $1 into it, 30 cents of the dollar you put into it is going to buy shares of death benefit. Those death benefit shares are going to pay you generally about 6 to 8% in dividends on an annual basis. You're getting these from a mutual insurance company, so you're basically a stockholder by owning a policy. They're paying you dividends, which is percentages of profit. The companies that you want to work with have paid these for over a century. Okay, through the Great Depression, through the tech bubble, through 2008, very steady and consistent. Why? Because your sacred account, that's what this is. It's in the Millionaire booklet, by the way. You need to have a sacred account. Your sacred account needs to be 100% safe. Okay, so 30 cents of the dollar you put into it's over there doing that. The other 70 cents goes into a liquid account that you can access immediately. That account's going to grow at a 1 to 3% rate of return. It can never go less than 1%. It probably won't ever go above 3% because it's just bonds. It's very liquid. Okay, so you've got $1. It's growing in two different places right now. That's called leverage. You can access that 70 cents. You're going to borrow against it. You're going to borrow probably 90% of the value of that 70 cents that's liquid. However, you're not accessing your dollar. You're telling the insurance company, give me a loan for this amount and use my money as collateral. By doing that, you get access to the funds tax-free, and your money never left the account. What does that mean? If I borrow it and I go do a real estate deal and I'm making 12% on my real estate deal, and I've still got the money in the account over here doing 1 to 3% on one side and 6 to 8% on the other side, I've basically taken $1 and turned it into $3. I've got it growing in 3 different places. Now, the other benefits of this, like I said, it has a tax-free aspect. It's protected. It's a contract between you and an insurance company. By the way, the money in the bank is not a contract between just you and the bank. Did you know your bank can restrict the access you have to your dollars? Check it out. It happened in 2011 in Europe. People were actually restricted on how much money they could take out of their personal checking account. Okay, the bank's allowed to do that. The insurance company can't. You basically can access the funds whenever you feel like it, and they can't tell you, hey, we don't have money because we gave it all away to the Federal Reserve. That doesn't happen here. Okay? Now, the next thing on this is the liquidity aspect. You're not sticking it in the market. That's why indexed universal life does not work. That's why variable universal life does not work. That's why mutual funds don't work. You're putting your money in the scam when you're doing those programs. You're sticking your money in the stock market. We've already gone over the terrible things that happen in the stock market. You don't want to do that. Okay? Now, the final thing that I want to talk about with this is the fact that this is your go broke account. Okay? Grant talks about have a sacred account that you go broke in every month. This is something that you have your account established. You've got the fractional reserve banking is what that's called, which by the way happens to your money already. Okay, the idea that I just talked about where you take $1 and you split it into 3 different locations, your bank already does that. I don't know if you're aware of this. When you put $1 into a bank, $1 into a bank, that bank is allowed to take that dollar and lend it out to 9 different people. It's called fractional reserve banking. Look it up. So it's already being done to you. You just don't get any benefit. The bank takes your dollar and they lend it to somebody for a mortgage. They lend it for a car. They do whatever they do with it, and you're not making anything. Flip it. You need to be the one that's lending all of the money out and doing the fractional reserve banking, not the banks. Okay? So to wrap this up, this account is not for retirement. It's not an investment. It's not an account you're just putting money in and hoping it grows. It's your savings account. It's your go broke account. It means that you're sticking money in it every single month until you get 50 to 100 grand built up, and then you're going to go use that for real assets that produce income. Okay? Now, the sweet thing with this is when you do use the account, let's say for real estate, and you borrow against it and you're earning that money on real estate, when you pay your funds back into your account, which you're going to do anyways, it's just called saving. Paying money back to your account is called saving. When you put the money into the account, the dollar value is higher than what you took out of it. So if you took out 100 grand and you used it for real estate, when you put the 100 grand back in, it's more than 100 grand. And it's not because of the interest you earn from the real estate, it's because the money never left the account and it was growing the whole time while you used it over here. So guys, I know this was a longer video. This is very complex. It's not something that you just sign up for. It's something that you learn about, check out. There's literally 4 books that I have my clients read when they go into this strategy with me so they really get it. Most people don't get it. They just get sold a mutual fund or an insurance policy hoping that the guy's going to do a good job, which really the guy has no control over, right? You give the bright-eyed, bushy-tailed guy over at the mutual fund store your funds. He's not the one making the decisions, actually. The strangers that you don't know are making the decisions. I hope you know that. So, hey, check out the article I wrote. I'm going to post it in the comments. It has a further breakdown. If you would like to learn more about this, let me know. We can set up an appointment. I'm happy to dive into this with you. If you're a Dave Ramsey fan, no offense to Dave, but Dave sells programs to your church to make money. He's not an insurance advisor. Okay, he sells basically a pretty version of YouTube to your church with workbooks. That's what that is. So sit down and really learn about it. Don't just say, hey, I saw this on a movie once. That's never a good idea. So thank you for watching. Like, share, subscribe. I will talk to you later. Have a great Monday.